free fall on Wall Street. A rough start to the week. The mood isn't exactly cheerful. The Dow took a 300-point tumble. The S&P 500 sulking at its lowest since September. And, well, the Nasdaq is also feeling the pressure. Let's just say the Magnificent Seven are looking anything but that. Tesla, Meta, Nvidia, big names, they're all bleeding. And why? Because of fears of a recession. They're back in play thanks to Trump's tariff talk, which is making investors jittery. Is this going to be a downturn that is going to be short-lived? Is it going to be something we are looking at which is much larger? Geoff Dennis is joining us, independent emerging markets commentator. Help us make sense of what's going on right now. How worried should investors be, Geoff, now that Trump is talking up tariff policies, bringing back recession fears?
I think investors still have to be very, very cautious in the short term. I have no idea how far this is going to go down, but I don't think it's a buying opportunity at this stage, certainly not a short-term buying opportunity. I think there are three things that are really hurting the market right now. First of all, is the really serious growing fears that there is going to be a recession in the US. The data is terrible, frankly, recently, particularly some of the soft data, consumer confidence, business confidence. Your listeners will probably know, but the nowcast Atlanta Fed forecast for Q1 is around minus 2.5% annualized. That's a poor number. Secondly, there's massive uncertainty being created by the on-off, how much, who's going to get hit by tariffs, and what's the retaliation going to be like. That just freezes investment and probably investors too. And then thirdly, the other point I think is worth making is that the Fed really doesn't have a lot of room to cut rates here. Inflation this week's coming out. It's probably going to be still somewhat around 3%. So the Fed is sort of hamstrung here. They really can't do anything about it. So I think we've got to see these recession fears play out. And as you say in your intro, it's the winners of last year, especially the tech sector, that are getting hit the most.
Inflation data, which is, of course, going to come as well this week with CPI and PPI reports. So do you think cooler inflation is going to help matters? Will that reading help reverse the market's downward trend? Do you think that's possible too?
I think it's possible, but it would have to be a very nice downward surprise. I think the consensus apparently is looking for maybe a downtick of 10 basis points. We may be talking about, going from just below 3%. But unless there's a big surprise, bringing inflation down sharply into the, say, 2.5, 2.7% range, which I think is extremely unlikely. But if that were the case, I think that would stabilize sentiment. I think the bigger danger, frankly, is that, the inflation numbers simply reiterate the fact the Fed has got very little room to move. And that's not helpful when the economy is under the pressure it is under now. And also, of course, as you will know well, Trump is just blowing this off. It doesn't matter. It's a short-term blip, sort of thing. It's a little bit of uncertainty. Well, I think economic actors, particularly corporates and to a certain extent consumers, are telling everybody and telling the market effectively that this is a bit more serious than that.
You mentioned that the Fed has been rather cautious about rate cuts, and they have very little legroom right now with the market turbulence, the tariff risks. Do you think the Fed will more likely take an aggressive stance on easing?
Not yet, for sure. I mean, they will take an aggressive stance with easing if the data deteriorates markedly from here. In other words, as opposed to what Fed Chair Powell said last week, that he thought the economy was doing okay. If we got to the point where it became clear that we were indeed going to go into recession, which I think would only probably be a mild recession, there's no major structural issues, I think, that the US economy has to deal with in any downturn. I think if you saw a much increased chance of a recession, let alone going into recession, the Fed would move, and they would probably move more quickly if inflation dropped much more rapidly towards 2%. But at this stage, the Fed is calling for 250 basis point cuts in 2025, and I think that sounds about right. And there doesn't seem to be any early indication from the Federal Reserve they're going to cut quickly here. And I think they need more data on the economy and more data on inflation. So meanwhile, the Fed is not going to come riding to the rescue at this point, as far as I can see.
Looking at the impact playing out in high growth sectors, we're looking at tech stocks, Tesla, Nvidia, Alphabet, all of them taking big knocks right now. Jeff, does that dent investor confidence more than when these stocks aren't the ones taking the brunt?
Probably the case. I mean, I think that they've been such the focus for several quarters, and now, of course, they're all going the other way. There's a different story with every one of these, but generally, the tech stocks led for so long, and now, obviously, logically, they're the one's getting hit the most. I mean, there are plenty of stocks, particularly in the consumer staples sector, probably in things like utilities and possibly some of the banks as well, that are holding up much better. It's a classic sort of rotation play. When the market starts to go down after such a big rise, it's the big winners, the big high beta names that tend to get hit the most. And frankly, you're seeing that across emerging markets as well, because the big four markets in the emerging world have exactly reversed their performance from 2024. So China and Korea are doing well, and Taiwan, and as you know well on this show, India are doing poorly. So this is turning into a classic contrarian or rotation year, and the technology sell-off is part of that. And that's because I think a lot of stuff got priced in at the end of last year about Trump. And as far as we know from here, it's got a lot more uncertain and the data's got worse. And that's a classic environment for, I think, the losers of a prior period to do well.
Well, we'll have to keep monitoring because there are so many uncertainties and moving pieces as well. And we're looking at crude oil prices. We're looking at geopolitical risks and the tariff troubles. The tremors that it causes creates a lot of uncertainty, which is clearly evident right now. So whether it's Trump's tariffs or the Fed policy, the global economic headwinds, investors are going to have to stay very nimble, like Geoff is pointing out. Geoff, great insights as always. Thank you, John, for joining us tonight on Business at 9 as well. We'll take a very quick